Okay, let's go ahead and get started. Happy Friday, everyone. Welcome aboard. Welcome to our weekly Outlook webinar. This is Ilian Yotov. I'm familiar to a lot of traders as the creator of the quarter steering method. I also host a popular program called the All Things Forex broadcast, Monday through Friday on my website, allthingsforex.com. It is also available for you to listen on fx3.com and other popular Forex websites. With that said, I'd like to thank our friends at fx3.com for putting together the series of webinars, weekly Outlook webinars. And what we're here today is to prepare for the trading week ahead of us, April 16th to April 20th. This current trading week was a little bit light on economic data. It was also holiday shortened in a lot of major markets around the world because of the Easter holiday. Next week, however, is going to be much busier than the current trading week. We have a list of important economic reports that are coming up from the Eurozone, from the United States, and also from the United Kingdom that, in my opinion, are going to keep the spotlight on these three currency majors, the euro, the US dollar, and the British pound. The very first of the top 10 spotlight events that I have chosen for next week is going to come from the United States with the U.S. retail sales. This, of course, is an important measure of consumer spending. Many of you perhaps know that the U.S. economy is more than two-thirds of it is services related, and therefore consumer spending is very important for the economic recovery. However, the consensus forecasts are expecting weaker retail sales. On a month-over-month basis, the number forecast is for retail sales to increase by 0.4% month-over-month. Now, this is compared with 1.1% in the previous month. This report, in my opinion, could be the first one next week of what could be a series of reports that show some signs of U.S. economic weakness. Why is that important? Because for a number of months now, pretty much since the beginning of the fourth quarter of 2011, on this program, on a weekly basis, I have been bringing your attention to the fact that if you want to gauge the future fate of the US dollar, you have to gauge the market's expectations for whether or not the Fed will do more quantitative easing, which is also known as the QE number 3. And since the beginning of the fourth quarter of 2011, I have began a quest to find out at that time whether the U.S. economic conditions were really as bad as the Fed's gloomy outlook at that time painted them to be. I'm quoting my own words, by it, from what I said in October of 2011. The reason why I started that quest is because paying attention to U.S. economic data and conditions was important for me to gauge whether the Fed will do more quantitative easing. At the time, by the way, the markets were expecting that the Fed is going to do more quantitative easing. However, U.S. economic data starting at the fourth quarter of 2011 has shown signs of improvement. And it has been a positive trend, as we discussed recently on this program as well. In the last couple of quarters, the U.S. economic reports have shown signs of resilience from the U.S. economy. A lot of sectors improving, and especially also the jobs market improving. Unfortunately, however, beginning with the latest non-farm payrolls report from the United States, which is the main gauge of economic health and conditions in the labor market here in the United States, we saw weaker than expected non-farm payrolls report. Refresh your memories, last Friday we saw the U.S. economy adding 120,000 jobs compared with expectations for another month of job creation above 200,000. That was the disappointing part of the report. Again, it's not the U.S. economy bleeding jobs or not creating any jobs. It's still creating jobs. It's just not creating them as of the month of March at the pace that it has been before. So the non-farm payrolls report last Friday was an alarming sign, a bit of a red flag, if you will, that U.S. economic conditions, especially labor market conditions, could start deteriorating. that, by the way, is expected by the consensus forecast that I've also discussed on this program, and also on my daily All Things Forex broadcast. What I'm referring to is some reports and some estimates for the U.S. economic growth in the first quarter of 2012, which the gauges of that we're going to start seeing in the weeks to come. For what the U.S. economic growth was in the first quarter of 2012, many forecasts, consensus forecasts, are pointing to a slower U.S. economic growth in the first quarter, from 3% in the fourth quarter of 2011 to 2.3%, according to the average median consensus forecast. And if you have to look at month-over-month gauges that are put by Moody's of the U.S. GDP in the first quarter, they are actually forecasting even lower economic growth in the first quarter of 1.8%. Well, if that is the case, and if the U.S. economy starts slowing, and we continue to see some alarming signs of weakness from the U.S., then that, as many of you know, will raise QE number 3 odds. The market is trying to gauge, and it's very interesting, as I spoke earlier on my All Things Forex Growth this morning, it is becoming more and more apparent that the market is looking for a direction and gauging the next move not only by the Fed, but also by the European Central Bank. Interestingly enough, there is clear divisions among policymakers, not only at the Fed, but also at the European Central Bank. There is a potential for the European Central Bank to do more bond purchases, which is a form of quantitative easing, or, as it's called, the long-term refinancing operations to recapitalize banks. That would be LTRO number 3. There's also potential for the Fed to do QE number 3, or another round of quantitative easing here in the United States. So from that perspective, as long as both of these central banks, the European Central Bank and the Fed, are expected to expand their quantitative easing operations or accommodative monetary policies, both of these currencies could continue to be weak. I'm referring to the euro and the US dollar both. And it is not any wonder to see what we are currently seeing. For the last couple of months at least, we are seeing range-bound price fluctuations of the euro-dollar exchange rate. I am taking you to the daily chart of the euro-dollar pair. Let me minimize. Hopefully that will give you a better view. And this is the range where the euro-dollar pair has been stuck within since pretty much the beginning of February. It is a range of approximately 500 pips that coincides with what I would call in my quarters theory, 2 large quarters of 250 pips each, between $1.30 and $1.3250 large quarter points, and then $1.3250 to $1.35 large quarter. 2 large quarters, 500 pip approximately range. There's a double bottom or double top resistance rather, serving as the top of the range. That's at the $1.3485. 2 identical highs that were reached in early February, or late February, I should say. And then approximately $1.30, major large quarter point in my course theory, serving as the bottom of this existing range. A low there at the $1.2973 from February the 16th, and recent lows at the $1.30, $1.3002 from March the 15th, serving as the bottom of the range. No wonder that the euro-dollar pair is simply trendless, fluctuating in this 500 pips approximately range between $1.30 and $1.35, as the market, as I said earlier, is looking for a direction and trying to gauge the next move, and there's no clarity at this point what the European Central Bank will do, and there is no clarity what the Fed is going to do. There are divisions. There's opposition to the European Central Bank as policymakers. There are opposition for them to continue buying bonds or doing long-term refinancing operations, because that expands, obviously, the balance sheet of the European Central The Fed policymakers here in the U.S. are also divided. Some of them are already coming out saying, well, we should consider starting to tighten monetary policy before the promised deadline, which is late 2014. Others are saying, wait, not so fast. Let's wait and see, because economic conditions could deteriorate, and if we start tightening too soon, then that will jeopardize the economic recovery. So you see, that is why I'm saying there's no wonder the euro-dollar pair is trendless. And as long as that continues to be the case, as long as we don't have a clear idea as to what's the next move by the European Central Bank or the Federal Reserve, then we could see more of the same throughout next week. And that would be more range-bound price fluctuations for the euro-dollar exchange rate. Currently, the euro is being put under pressure today because of the concerns that the Spanish banks are borrowing more from the European Central Bank, which is a valid concern. And also in the last couple of weeks, we had a bit of a reminder that things could get ugly very, very quickly, literally in a matter of days, when we saw borrowing costs back on the rise from Spain, Italy, and even the second largest economy in the Eurozone, France, that saw borrowing costs rising. Now, if that continues to be the case, obviously that could put additional pressure on the euro and further risk aversion and investor concerns about the fire spreading, if you will, from the European debt crisis into the larger economies is going to be a potential catalyst for the euro to break below the bottom of this existing range, below the $1.30 level. But if such catalyst is not found, then obviously the euro-dollar pair could continue to be trendless. Needless to say, now that we know that the euro-dollar pair is range-bound, and we know exactly what are the levels serving as the top or the bottom of this range, we have to be very cautious and pay close attention to these levels, because obviously if decisively broken either above or below, then that would mean a more significant move for the euro versus the dollar. If the bottom of the $1.30 is broken significantly below and we have a decisive breakout, then that could open the door for the euro-dollar pair to produce another significant leg lower, similar to the legs that we've seen in October and similar to the legs that we've seen in the recent months. Or I should say in late 2011 rather than just October. Here's the first leg lower that started, last summer in August. The euro dropped from $1.40 above $1.45 down to support found at $1.3144 on October 4th. Price correction here, and then another leg lower where the euro dropped from about $1.4250 large quarter point down to the $1.26 area. $1.2622 was the support level established on January the 13th. The euro obviously has corrected some of these losses. It fluctuated trendless, and now a break below the bottom of this range, decisive breakout, not just a few pips of an overshoot, could open the door for the euro-dollar pair to give us another leg lower that would be similar, more than likely, to the legs that we've seen in August and October, November of last year, and December of last year. So that would be the implication of the euro-dollar pair breaking below $1.30. On the other hand, if there's no massive risk aversion, there's no concerns that the crisis will take a turn for the worse, then the euro at that time will more than likely sustain above $1.30. If that is also coupled with more signs of weakening from the U.S. economy, which raises the odds of the Fed doing more, which is the cold words, as I call them, for more quantitative easing, or QE number 3, then that would weigh on the U.S. dollar as well. As we know that QE 3 is not completely out of the picture, and as long as it's not completely out of the question, then that could continue to weigh on the U.S. dollar. Needless to say, both of these currencies are weak at this point, and hence the trendless range-bound environment. Now, this is why next week is going to be crucial for us to continue to pay close attention and gauge economic conditions on both sides of the Atlantic, in the Eurozone and in the United States. And unfortunately, the retail sales report on Monday morning is not expected to be very strong. So it could continue these alarming signs of weakening from the U.S. economy. Labor market non-farm payrolls report, as I mentioned earlier, showing us that the U.S. Labor market job creation is slowing. Yesterday, we had an unexpected jump in the jobless claims from about 350 to 350,000 to about 380,000. And retail sales now, if we start seeing weakening also on Monday morning, it's not in the top 10 events, but Treasury International Capital data is being released on Monday at its usual time, 9 a.m. Eastern time. That could be another report there that could put pressure on the U.S. dollar. The reason I'm saying that is because the Treasury International Capital data is ultimately a gauge of the attractiveness of the U.S. dollar or U.S. dollar denominated assets to foreign investors. How attractive are these U.S. dollar assets and U.S. dollar in general? Well, we had a pretty decent demand at $101 billion in February. However, the consensus forecast for the Treasury International Capital on Monday morning is expected to show $41.3 billion, which is significantly lower than $101 billion demand we saw in February. So keep an eye on that report as well. That could be cause of concern for the U.S. dollar as well. Now, next Tuesday, we're going to start the sequence of important U.K. economic data on Tuesday and Wednesday of next week, going all the way up to Friday with the U.K. retail sales. But the first of the important reports from the U.K. is going to be the Consumer Price Index on Tuesday. And this, of course, is the main measure of inflation, which the Bank of England prefers. And we know the Bank of England has recently decided not to expand the size of its asset purchase program, which is ultimately a British pound positive if the Bank of England does not do more quantitative easing, especially in light of expectations that the European Central Bank and the Fed might continue to do more quantitative easing. If the Bank of England refrains from that, I see that as a potential British pound positive, simply because it could increase the amount of buying interest for the British pound if the euro and the dollar are put under pressure on expectations that both of their central banks will do more to stimulate their economies and do more quantitative easing. So I would not be surprised going forward if the British pound begins to attract some bids, if you will. So it's no wonder that the British pound is close to the top of its existing range, compared with the euro-dollar pair, which is closer to the bottom of its existing range. Pound-dollar pair, as I will show you in a minute, is strategically positioned close to the top of its existing range. The consensus forecast for the Consumer Price Index from the United Kingdom is for a little bit of an increase in inflationary pressures, which also, by the way, is a British pound positive, because rising inflationary pressures are going to not create an environment that's going to be a comfortable environment for the Bank of England policymakers to continue more quantitative easing and create more inflation. In other words, the Bank of England could be less accommodative if we see inflationary pressures in the UK rising again. Now, the Consumer Price Index is expected to increase in March to 3.5% year over year, which is a little bit of an increase from 3.4% in the previous month. Again, it's not significantly higher, but if it does go up a little bit more than 3.5, which is the consensus forecast, that ultimately I see as a British pound positive report on could keep the British pound supported on Tuesday morning. Of course, when we talk about the British pound or any other risk dependent currencies, we have to put a little disclaimer. Provided, and the disclaimer is provided that there is a positive investor sentiment and risk appetite. Because we know the pound is not going to be immune from risk aversion. It will put pressure on the pound if we get to see concerns re-emerging that the debt crisis takes a turn for the worse and so forth and so on, or that the worldwide economies are slowing, which, by the way, is the concern today with the Chinese gross domestic product report showing slower than expected economic growth in China, which is the second largest economy in the world. And now if we start seeing, especially also throughout next week, signs of weakness from the U.S. economy, then that could cause investor sentiment to deteriorate and ultimately lead to more risk aversion. So the consumer price index from the UK is expected to show inflationary pressures inching a little bit higher, which I feel could be a British pound positive. Now let's go ahead and take a look at the daily chart of the pound-dollar pair so that you can visualize what I was explaining earlier. Now this is a currency pair that's no news to anyone who listens to this program. Since last October, that the pound-dollar pair is trendless as well. Just as the euro-dollar pair in the last couple of months, the range for the pound-dollar pair has been lasting for a lot longer, since last October of 2011. Now, since then, I've been talking about this range that is, give or take, about 900 pips between $61.65, which is the high from October 31 of 2011, serving as the top of that larger range, and approximately an important level in my quarters theory, which is the $52.50 large quarter point, serving as the bottom of that range. He had a low at $52.70 on October the 6th, and a low at the $52.32 on January the 13th of this year. The point between these two lows is pretty much the large quarter point of the $52.50. That is why I am saying that this is serving as the bottom of the range, that $52.50 large quarter point in my quarters theory. Now, within that larger range, in recent few months, the pound-dollar pair has established a smaller range, which was about 400 pips of a range between $56 and $60. The top of this range was challenged last week, and the pound-dollar pair reached its high at $60.61. But, of course, no follow-through on that breakout was given, and the pound was put under pressure again, and simply fell right back in recent days below the top of that smaller range, which is the $1.60 area. And that is where yesterday the pound attempted to target the $1.60 area again, and was not successful as far as breaking. It's pulling back from that level as we speak in a trading session today. However, as I mentioned earlier, I feel that the pound-dollar pair is strategically positioned. And it needs, obviously, a catalyst to break above these ranges, whether it's the top of the smaller range or the top of the larger range. I don't see the catalyst emerging next week for a breakout above $61.65 or a break above the larger range since October. But I'm not excluding the possibility of the pound challenging these recent highs at $60.61 and maybe even $61.65, and I will explain why. Not only because of potential for inflation pressures to rise, but also on Wednesday, the Bank of England meeting minutes is another important report that is due from the United Kingdom that could actually help the British pound, in a way that if the minutes were to reveal that the Bank of England is at this point not in any hurry to start doing more quantitative easing, at their previous meeting, 2 of 9 Monetary Policy Committee members voted for an increase in the size of the asset purchase program, which is their quantitative easing program. That, of course, is not a British pound positive, because if the Bank of England is expected to do more quantitative easing, that would be at the expense of the pound, as it will be at the expense of the US dollar if the Fed does QE number 3. On the other hand, however, the consensus forecast for Wednesday's minutes report from the Bank of England's April meeting is the vote to be 0 to 9 instead of 2 to 7 for more quantitative easing. In other words, the two that voted for an expansion of the asset purchase program are expected to refrain from calling for it again at the April meeting. So we can have the majority, well, I should say unanimous decision to keep the lid on the quantitative easing program and to keep rates at the record low level, 0.5% as well. So as long as Bank of England refrains from doing more quantitative easing, I feel that that is a British pound positive. And if the Bank of England steers away from doing more quantitative easing, and at the same time the market's pricing in the European Central Bank and the Federal Reserve to start to keep doing more quantitative easing, then that is why I said earlier we could see the pound starting to attract more and more business in such environment, provided, of course, here's again the disclaimer, provided that we don't see significant deterioration in investor sentiment and risk aversion. So that's why I feel the pound is strategically positioned here, close to the top of the smaller range at least, for a possible move to the top of the larger range. Can it find the catalyst for a break outside of this larger range? I can't see it at this point unless the Fed comes next week and says, yes, we're announcing that we're doing more quantitative easing, which is not very likely to happen next week. But QE number 3 expectations will continue to weigh on the US dollar, as we know. Going forward with the list of important economic data, on Tuesday morning, we'll see two important spotlight events from the Eurozone, starting the sequence of economic data from that region with the Harmonized Index of Consumer Prices and the ZEW Economic Sentiment Index scheduled for release both at 5 a.m. Eastern Time on Tuesday morning. Now, inflationary pressures, Harmonized Index of Consumer Prices is the main measure of inflation preferred by the European Central Bank. And we have seen a little bit of a pullback in inflationary pressures down to, what was it, 2.5%, wasn't it? From 2.6 from 2.6% from 2.7 in a previous month. And that is what the consensus forecast is expecting, 2.6% year-over-year inflation in the Eurozone. So if inflationary pressures are subsiding, not rising, then the European Central Bank could afford to be accommodated if inflation is not an issue, which could weigh on the euro. What could also weigh on the euro is if we get to see weakening in the economic sentiment outlook. According to the ZEW index in Germany, the economic sentiment is expected is expected to show a lower reading at 20.2 from 22.3 in the previous month, and the ZEW index for the entire Eurozone is also expected to be a little bit lower at 10.7 from a reading of 11 in the previous month. Again, if there is weakness in the Eurozone economy, that would keep expectations of the market that the European Central Bank could be forced to do more, which is not going to be very much a euro-positive underlying fundamental factor. Also on Tuesday, we'll see the U.S. Housing starts, which is an important gauge of housing market activity. And I'm not expecting any spectacular improvement in the U.S. housing market, and that more than likely will be the outcome of the housing data throughout next week. We'll have the housing starts and building permits on Tuesday and the existing home sales on Thursday. of next week, housing starts are expected to increase very minimally from 700,000 in February to 710,000 in March. That's really nothing impressive. Building permits are expected to decline from 720,000 to 710,000. Really a mixed bag of housing starts and building permits data, not anything spectacular, as I said earlier. So another potentially weak economic report from the U.S. due on Tuesday. That will lead us to the Bank of Canada interest rate announcement on Tuesday morning at 9 a.m. Eastern Time, which Bank of Canada is, in my opinion, another one of the major central banks that is expected to maintain the status quo. In other words, do nothing at this point, keeping rates at the current level at 1%, and pretty much keeping a close eye on economic conditions in the U.S. especially, and around the world, but especially in the U.S. because we know that the U.S. is the largest trading partner of Canada. This is why many traders are shocked to see the Canadian dollar being put under pressure when we get to see negative U.S. economic data. Keep in mind of that close dependence and the relationship between the Canadian and the U.S. economies. Speaking about the dollar-Canadian dollar exchange rate, this is another major currency pair that is simply trendless, range-bound, and here's the recent range in the last few months that's been established for the dollar-Canadian dollar exchange rate. It's a couple of hundred-pip range. Identical highs, which we can actually call a triple top resistance, established here around $1.50 area. Recently, the dollar made an attempt to challenge that level, reached exactly almost up to the pip, the resistance, the top of the channel at 1.0051 on April the 11th. Obviously, the dollar did not produce a successful bullish breakout above the top of this range, and quickly was put under pressure in the last couple of trading sessions, falling off the top of the range. Now, what is the bottom of the range? It is the lows at in a 0.98 and a half area. And this is why I said it's about 200 pip range that the dollar-Canadian dollar pair is confined within. And just as I mentioned with the other major currency pairs, the euro dollar and the pound dollar, this is a range-bound currency pair. We know it's a well-established range, and this is why we would have to pay close attention to the top and the bottom, resistance and support areas. Only a break above the top of this range or a break below the bottom of this range will give us a more definite trend direction for this currency pair. But this is another currency pair that could continue to do more of the same next week, and that is range-bound price fluctuations, unless a catalyst is found. But I don't think that the Bank of Canada will be the catalyst next week for a possible breakout. Moving forward, on Wednesday morning, we'll see the Bank of England meeting minutes and the United Kingdom jobless claims. There's a fancier name for that, claimant count change, which is a fancy name for jobless claims in the UK. It's obviously jobless claims is an important gauge of employment trends and labor market conditions. If more people are claiming unemployment benefits, then that is not going to be positive for the British pound. The labor market there in the UK is not doing very well. If you have been paying attention to the labor market reports in recent months, last month, 7,200 more people claimed first-time unemployment benefits in the UK. Well, at least on Wednesday, the consensus forecast for the Wednesday's report is to show a bit less amount of people claiming jobless benefits. 7,600 is the consensus forecast number at this point, which would be a little bit less than 7,200. Now, if that is not the case, however, obviously, if there's a reduction in jobless claims, that could be another report that would help keep the British pound supported. But if we get to see another month of unexpected increase in jobless claims in the UK, that would be an alarming sign from the labor market in the UK. That could put pressure on the British pound, because we know that deteriorating economic conditions in the UK, coupled with deteriorating economic conditions in the Eurozone, which is the largest trading partner of the United Kingdom, are going to have a negative impact on the British pound, because it would raise the expectations that the Bank of England could be forced to do more quantitative easing. And so you get to see how these are very closely linked, these factors. But at least the consensus forecast is expecting the jobless claims to be a little bit lower in the UK with the report on Wednesday morning. That will lead us to Wednesday night's report from Japan, the only of the top 10 spotlight events coming from Japan next week, the trade balance of the difference between imports and exports. And many of you know that Japan is mainly an exporting economy, and an economy like Japan should not be running a trade deficit. Exporting economies normally are expected to have a trade surplus. That, however, has not been the trend in the last few months. The Japanese trade balance reports recently have been showing trade deficit. In February, the deficit was 0.31 trillion Japanese yen. And the consensus forecast for Wednesday's report is expected that trade deficit to widen, to become larger, showing 0.43 trillion yen trade deficit. Ultimately, that is a report that could weigh on the Japanese yen. It is an alarming trend if the Japanese deficit rises. It will be also a sign that the Japanese economy may not be doing very well. And ultimately, if that continues to be the case, that the Japanese economy is not doing well, that could put the sense of urgency for the Japanese authorities to do more to stimulate the economy and to weaken the Japanese yen, to help exports. Now, we saw a remarkable rally that was staged by the US dollar, and I'm showing you the daily chart of the dollar versus the Japanese yen currency pair. A remarkable rally in the dollar versus the Japanese yen that started in the beginning of February. However, as I have been calling, by the way, for weeks before it started, I've been calling for what I called a long overdue price correction for the dollar versus the Japanese yen. And indeed, that correction has taken place in the last few weeks, as anticipated. The dollar failed to continue that bullish trend and break above 84.17 high from March the 15th. It got close. It reached as high as 84.08, but that was not enough to produce a decisive breakout. As a result, the price correction of the dollar's gains began. As expected, the dollar during this price correction, and it was very easy to calculate, as I spoke at the time, it's not a rocket science, really. If the dollar gained about 800 pips during this rally, which lasted for about a month and a half, then up to 50% so-called perfect Fibonacci retracement of up to 50%. Could send, as I said at the time, the dollar lower versus the yen back to the major large quarter point, as I call it in my quarters here, a very important level at 80 yen, which is an important junction between two 1,000 pip ranges, 70s and the 80s, or the 1,000 pip range between 70 and 80 yen, and the 1,000 pip range that the dollar-yen exchange rate transitioned into as a result of this rally, which is the new 1,000 pip range between 80 and 90 yen. Dollar yen pair broke above 80 yen and moved above that level in late February. And it made further advances into the 80s, 1,000 pip range, reaching as high as 84.17. Now, on that price correction, it is going to be very, very important for us to pay attention to dollar yen behavior around the 80 yen level. Will the market push the dollar versus the yen lower, below 80 yen, back into the previous 1,000 pip range, or will the dollar show us signs of strength by remaining resilient and staying above 80 yen? That is the key question for me going forward in the weeks and months to come. Because the 80 yen area price behavior will be the key, to me at least, to see whether or not the dollar can muster additional strength to give us another leg higher versus the Japanese yen. If it doesn't, then the dollar falls back into the 70s. It falls back into the previous range between 75.5, record previous lows, and 80 yen, and we get to see more of the same, which has been the trend at least for the last 5 years for the dollar yen exchange rate. And that's a strong negative trend. Need I refresh your memory? I know 5 years is a long time for some people. But in 2007, do you guys remember what the high for the dollar yen exchange rate was in 2007? Go back and check it out. It was above 124 yen. Yes. Believe it or not, the dollar yen exchange rate did trade at these levels. And it wasn't that long ago. It was a few years back. So, needless to say, it's a strong bearish trend that the dollar is still in, despite of this rally for a month and a half. That, as I called it at the time, is not the reversal of the multi-year bearish trend for the dollar against the yen. It is simply a more significant price correction of the dollar's loss. And that correction could continue, by the way, if the dollar stays above 80 yen and is capable of strengthening further from that level on. And, of course, breaks above the recent highs at 84.17. The dollar correction could extend at that time towards the 90 yen area. And even if the dollar rallies to 90 yen, even if it rallies to 100 yen, that will still be mere price correction and not the reversal of the multi-year bearish trend for the dollar. It's actually lasting more than 5 years, that bearish trend. But at least in the last 5 years since 2007. So that is why the 80 yen level will be crucial. Now, during this price correction, as I said, we could see the move to 80 yen, or at least, and I'm quoting my exact words, at least towards the double bottom support at 80.57 yen. This is the double bottom support there. 80.57, two identical lows established on March the 7th and March the 6th. This is exactly the area that the dollar-yen exchange rate challenged earlier this week, reaching support at 80.55. It overshot the double bottom support by 2 pips, but it didn't break below. So far so good. The dollar is sustaining above that double bottom support. And even if it breaks below it, then the 80 yen area is going to be an important area of support that we'll have to watch. If the dollar shows signs of resilience and manages to stay above 80, to me that's a bullish sign. And then later on in April, on April the 27th, we're going to see another monetary policy meeting by the Bank of Japan, which, by the way, I would not be surprised to see the Bank of Japan doing more quantitative easing. After all, they're trying to do 3 things, and quantitative easing works for all these 3 goals that the Bank of Japan currently has. Quantitative easing is a tool to weaken the yen, create inflationary pressures, and at the same time stimulate the economy. 3 things that the Bank of Japan's monetary policy is focused on. Moreover, not only the increase in February of the additional 10 trillion yen, which by the way made perfect sense to me, as I spoke at the time, for them to do more quantitative easing and expand their quantitative easing program, and they did so by raising it by 10 trillion yen. They added another effective tool that has proven effective as far as weakening the Japanese yen during these month and a half. That tool was the talk of the Bank of Japan setting an inflation target of 1%. So if the Bank of Japan wants the Japanese yen to continue to weaken and to prevent the dollar from falling back into the 70s, falling significantly below 80 yen level, don't be surprised if the Bank of Japan does more quantitative easing, and even don't be surprised if they start talking about a larger inflation target. Instead of 1%, perhaps 2% inflation target, which, by the way, is the inflation target of many other major central banks. I like to keep inflation around 2%, other central banks. So those are a couple of effective tools that, in my opinion, could weaken the Japanese yen if the Bank of Japan gives us that on April the 27th, which, by the way, will be an interest rate meeting or monetary policy meeting by the Bank of Japan that will come literally 24 hours after the Fed's meeting, which is a 2-day meeting on April 24th and 25th. This is why in the next couple of weeks, the markets will continue to gauge the next moves, pay attention to economic data from both the U.S. and Japan, and at the same time gauge how that would impact the monetary policy decisions by both the Federal Reserve and the Bank of Japan. And the Japanese trade balance on Wednesday, if it does indeed shows an increase in the trade deficit, may be a contributing factor for the Bank of Japan to consider more quantitative easing, and maybe even a larger inflation target as well. Now, I already mentioned that yesterday we had an alarming development with the jobless claims jumping in the United States. Again, a couple of negative reports are not going to change the Fed's mind as far as force them to do more quantitative easing, but if this now starts being the new trend where the U.S. labor market conditions are deteriorating and the U.S. economy starts weakening and slowing down, a couple of months of that type of a trend is going to raise QE number 3 expectations exponentially, in my opinion, and that would not be a U.S. dollar positive. Jobless claims jumped to 380,000 last week, according to the report yesterday, and now next week they might stay in that area, by the way. 370 to 374,000 is the range for jobless claims. And if they do not stay below 380,000, then that would be another consecutive week of U.S. jobless claims staying at elevated levels off of their 4-year lows, jumping up from their 4-year lows that were reached recently. So we'll watch the jobless claims report as well next Thursday. That will lead us to the existing home sales report, which is the main gauge of housing market conditions in the U.S. Again, I'm not expecting anything spectacular from the U.S. housing market. The consensus forecast is for 4,620,000 existing home sales, which is nothing to brag about from the 4,590,000 in the previous month. Again, really, nothing really spectacular from the U.S. existing home sales. And on Friday, another important report from the Eurozone that will help us gauge conditions on both sides of the Atlantic, the German IFO Index of economic and business climate and expectations in the largest economy in the Eurozone, Germany, is expected to show a reading of 109.6, which is a little bit lower than 109.8. So if that index is lower, then it could be another sign of weakness from the Eurozone as well. This is all the time I have for today's webinar, but I would like to invite you to listen to my daily outlook on the All Things Forex live daily broadcast Monday through Friday on allthingsforex.com. You can also follow me on Twitter for the latest updates at allthingsforex is the Twitter account at allthingsforex. With that said, I'd like to thank you for attending today's webinar. Thank you to our friends at fx3.com for putting together the list of these weekly webinars. Thank you very much. Have a great day and a great weekend, and I'm looking forward to seeing you again next Friday at 10 a.m. Eastern Time.